Welcome to this explainer on contractor setup and ongoing payment management. Now, right out of the gate, I want you to think back to our previous discussion in Section 03. We covered employee onboarding, right? We saw new hires filling out W-4s, getting set up in the payroll system, and going through a really heavily dual-reviewed setup process. Well, today, we are looking at a completely different world. Contractors operate under an entirely different set of rules. Instead of W-4s, they've got W-9s. Instead of sitting in your payroll system, they exist solely as vendor records over an accounts payable. And instead of a standard offer letter, their entire working relationship is governed by a strict services agreement. The boundaries between these two worlds are absolute, and today we're going to explore exactly how you maintain those boundaries.
Okay, let's dive into this. We're going to follow the complete chronological life cycle of contractor management today. We'll start by defining the AP boundary line, move right into the 3 setup documents you absolutely need before any work begins, look at the 6 critical payment controls, tackle the year-end 1099 NEC reporting, and then wrap the whole thing up with the formal closeout process.
So starting with Section 1, the AP boundary line, keeping the worlds apart.
This boundary right here is the foundational rule for literally everything we're going to cover today. The employee track and the contractor track are fundamentally opposed to one another. The contractor track lives entirely in accounts payable. They submit invoices, not timesheets. They get 1099 NEC forms at year-end, not W-2s. And every single control we are about to unpack exists for one reason: to keep contractors firmly on the AP side of that line. Why? Because the very moment contractor payments start drifting into payroll systems or payroll accounts or employee benefits programs, the legal integrity of that independent contractor relationship begins to completely collapse.
Moving on to Section 2, the 3 setup documents. This is about building your legal defense. Before a single hour of work begins, and I mean absolutely before a single penny is paid, these 3 specific documents must be in place. First up, the Independent Contractor Services Agreement. This has to include really explicit, no employment and no benefits language. And listen, this isn't just standard legal boilerplate that you skip over. It's vital legal protection. If you leave it out and get challenged later, your company's position is significantly weakened. It also makes sure all the intellectual property created during the job actually belongs to the company. Second is your Statement of Work, or SOW. And third, the Form W-9.
Now, what's really interesting here is imagining an IRS auditor flipping through your statement of work and reading a line like, available Monday through Friday, 9 a.m. to 5 p.m. That is a total nightmare scenario. Why? Because an SOW has to describe outcomes and deliverables, not work schedules or methods. The moment you start telling a contractor how and when to do the work, you're introducing a massive behavioral control factor, and that heavily supports reclassifying that worker as a full-blown employee. Remember, an SOW is the baseline for approving invoices. If there's no deliverable spelled out in the SOW, there's no payment.
And this brilliantly illustrates the sheer financial stakes of our third document, the Form W-9. Let's play out a scenario. Say your company pays a freelance consultant $12,000 across the year, but someone forgot to collect their W-9 before that very first payment went out. Well, without that W-9 on file, a backup withholding penalty of 24% applies to all of those payments, automatically. Suddenly, your company's on the hook directly to the IRS for the 24% that should have been withheld from that $12,000 but wasn't. Ouch, right? Always collect the W-9 before the first payment and retain it for 4 years after the last payment, literally no exceptions.
All right, Section 3, 6 critical payment controls, guarding the gate on every invoice.
So once your setup is perfect, the ongoing payments phase begins. Now, the AP process for contractors looks a lot like standard procure-to-pay, but with incredibly strict oversight. Before we even list the controls, we have to get this core concept down: deliverable-based payment. Finance should only approve an invoice based on a confirmed outcome. The project manager actually has to confirm the deliverable is complete. It's kind of like the AP equivalent of a goods receipt. Do not pay contractors just for time worked if there's no confirmed deliverable attached. Paying someone just for their presence rather than their output, that's another behavioral control factor that can trigger an ugly employee reclassification. Here we go. The 6 critical controls governing every single contractor payment. You've got to verify the classification is still correct, match the invoice to your remaining SOW balance, ensure there is 0 standard tax withholding happening, track those year-to-date totals, and of course, only pay for confirmed deliverables. So the crucial point is really centered on avoiding your 2 most expensive exposures. First, like we just talked about, that W-9 absolutely must be collected before payment. And second, look closely at rule number 6. Never, ever Pay a contractor through the payroll account or the payroll system. Payments have to come from the operating account via ACH, check, or wire. Keep them separated.
Let's move to Section 4 and see how this builds. Year-end 1099 NEC reporting, the deadline rush.
This is exactly where our daily invoice controls evolve into strict year-end compliance reporting. Form 1099 NEC, which stands for non-employee compensation, has to be issued to any individual or single-member LLC you paid $600 or more during the calendar year for their services. Now, usually C corporations and S corporations are exempt from this reporting, but there is one major exception you absolutely have to remember. Attorneys and law firms are never exempt. Even if they are a massive incorporated firm, they still get a 1099.
To manage this, you need a running year-to-date tracker going throughout the year, updating it after every single AP payment cycle. Seriously, do not wait until January to try and compile these totals. It's a mess. Before year-end, you've got to run all contractor taxpayer identification numbers, or TINs, through the IRS TIN matching program. If you just guess and file with a mismatch, you are going to trigger a CP 2100 notice from the IRS. It's a huge headache, and it actually might force you to start enforcing that 24% backup withholding on all their future payments.
The strict deadline here for both issuing the form to the contractor and filing it electronically with the IRS is January 31st. You simply cannot fall behind on this. Standard penalties for being late range from $60 to $310 per form, depending on how late you actually are. But if the IRS decides there was intentional disregard on your part, that penalty skyrockets to $630 per form. And guess what? There's absolutely no cap on that penalty. The financial stakes for failing to file accurate, timely 1099 NECs are incredibly high. Which brings us to our final section, Section 5, the formal closeout process, tying up loose ends.
You know, simply letting a contractor stop showing up or stop sending invoices isn't enough. When an engagement ends, whether the SOW is finished, the agreement expires, or you just terminate it early, you have to follow a formal closeout sequence. First, process that final invoice, but only after the project manager confirms every single deliverable is met. Second, legal has to confirm that all work product is delivered and that intellectual property ownership has safely and completely transferred to your company. Third, formally terminate the agreement in writing. A dormant but technically active contract just sits there creating ongoing relationship risk. And finally, step 4, update your 1099 tracker with that final payment amount so you're ready for year-end reporting.
And keep this in mind, if you think the same contractor might be re-engaged later down the line, you need a brand new SOW for each new engagement. Continuous use of a contractor on rolling SOWs over multiple years without a real break, that should immediately trigger a fresh classification reassessment. You definitely don't want to accidentally create the appearance of continuous employment.
Well, we have covered a lot of ground today maintaining those rigid boundaries of accounts payable for your contractors. Next up in Section 05, we're going to cross back over that boundary line. We'll be exploring recurring payroll operations for employees, which is that exact process that repeats every single pay period and has to be executed in the precise right sequence every time. But before we go, I want to leave you with something to think about. Take a mental look at your current vendor master list. Are your dormant contractor agreements silently building an expensive legal trap for your company? I highly encourage you to take these compliance life cycles seriously. Go review those old agreements and keep those boundaries sharp. Thanks for joining me on this explainer, and I'll see you in the next one.